Hello everyone, Dave Landry here from DaveLandry.com, and this is Trading Simplified, episode 48. Wow, every week I say I'm not going to get excited when I think about what episode, but it's just amazing how fast it's been going. Anyway, so what are we talking about? Well, I'm going to continue to show you the methodology in action. I think that's going to be an ongoing thing. When I started this week, I'm like, well, we're really not going to have a whole lot to show you guys. And then before you knew it, I had a plethora of things to show you. That'll make more sense in just 1 second. So we'll continue with the methodology in action. I have some mystery charts I want to update, some big lessons, and mistakes. And I think it's important for me to show mistakes when they occur, and that'll make a lot more sense in a few minutes. Housekeeping, I do take requests. As I've been saying ad nauseum, I'm a little backed up at everything. But what I've been doing is on Thursday nights, I do Dave Landry's The Week in Charts, and I've been covering a lot of those requests and questions there. So if you have time, I'd love for you to join me on Thursday nights, usually at 7 p.m. Eastern Time. So I also want to talk about solving your trading problems, and that's going to make a lot more sense when we get to it. If you need to reach me, DaveLandry.com/contact. If you want the slides to all of these presentations, all 48 plus some special presentations here and there, easy for me to say, go to DaveLandry.com/StockCharts. I'll also give you all three of my books in PDF format, and that's been well received, so that's kind of exciting for me. You guys are taking a look at those, and you like what you see. So get to know me first before you go any further with everything, and I'll also give you access to a market timing course and some basic introductory information, along with limited access to the members area. All right, let's talk about the mystery charts and the methodology and action, warts and all. So I want to show you my mistake of the week, and it's a doozy. This week's mistake of the week is brought to you by You Are Doing It Wrong. Voting. You Are Doing It Wrong. And by F-bombs. Dropping daily, at least in my office. Laugh to keep them crying. So I talked about this BEKE last week, and this was a stock that we were talking about in the Facebook group. And I nearly missed the actual entry on this, and I saw it right before the close. I was like, holy moly, I forgot about that one. Luckily, I was able to get in. Now, this is just a model account. I just like to show, based on this model account, which is roughly about 100K, that I'm actually taking these trades. And based on the amount of risk, $10, only 200 shares were needed to be traded. And that's what I actually did in this particular account. I actually did it in more than one account, which is kind of painful, but we'll get to that in just 1 second. Anyway, initial profit target up here about 10 points, or exactly 10 points above the entry, around 50. And you could see that it did rally up, hit the initial profit target, and I ended up selling half at a little bit less than 10. I gave up about a point and change, and there's a sell right there. As you can see, I was looking for 60. And I sold at 58.80, which is about $1.20, or exactly $1.20 below where I wanted to sell, or the initial profit target, I should say. Reason that happened was because I was trailing a stop intraday and trying to squeeze out a few more points. So let's say that this company really took off later today and ran another 10 points. Maybe a trailing stop could have captured another 5, 6, 7, maybe even 8 points on the trade. So I was just trying to squeeze a little more out of it. Not enough time, and this is not the proper venue to get into those more advanced details. But if you go to my YouTube channel, www.youtube.com/C/Dave Landry, you could check out the walkthrough that I did on that trade. It didn't actually work out, but sometimes it does, and you can squeeze out a lot of money. Now, what happens with a trade like this is when you get that initial profit target out of the trade, go in and watch the money management module. And by the way, within that, if you put your information in on that StockCharts link, DaveLandry.com/StockCharts, I'll give you a link to a page that has all of these shows on it, so you can go in and watch the money management show. Or you could, if you really want to fast forward things or jump it up a notch, take it up a notch, then go in and just become a gold member and take the money management course. But anyway, and that's just to tell you just so you know where I'm coming from. But basically, once you hit the initial profit target, you get that stop up to break even. Now, I was looking at my accounts, and I said, you know what? I don't want to let this thing go into a loss. So instead of just honoring my stop, which was only a point and change away, I said, to hell with it. I went ahead and exited this trade. And I'm like, okay, well, good. At least I made a little money on that second loaf by busting my plan, right? Well, take a look at what happened to the stock afterwards. It took off. And of course, I said, mother, father. And it came to 1,016 mistake times X. Now, I'm not going to tell you what X is, but trust me, I have more than one account, and I did take this trade in more than one account. I just like to show representative trades in this particular venue here. Anyway, and just looking at my quote screen right before I began recording, I saw it was up another $5 or so. So very, very painful. Add another 500 to that times X, and that's how much money I left on the table. So, and counting based on today's action. Now, you're probably thinking, why would the Grand and Poobah admit mistakes? I mean, these YouTube gurus out there, man, they pull up in their Lamborghini and they get on their private plane. And I was listening to somebody the other day, and I made the same exact argument. I'm like, is this guy listening to me? He was talking about gurus that actually called a few out by names, and they walk around with big piles of cash. And it's like, I don't know about you, but I just get these little blips in my account that go up or down. I don't actually have cash come out of my trading monitor. But anyway, I digress. No, I admit mistakes because it's like you make me want to be a better trader. And when I take a trade, especially if something that I announced publicly, like the BEKE trade, and that we talked about in the Facebook group, I don't want to look like a hypocrite. I want to actually practice what I preach. But in this case, I got out a little early and I broke the plan. So it's a little bit more painful, for lack of a better word, by showing you all this publicly. And I have a good feeling that next time this occurs, I'm just going to follow my plan and not try to micromanage and outsmart the market. The other reason I like to show mistakes, not that I want to make mistakes so I could show you, but it happens, spelled with a silent SH, is that it shows that we all make mistakes in this business and nobody's perfect. And I don't want to go off on a guru rant, but a lot of these gurus, they do a lot of shaming. And that's with the in front of the rented jets and the Lambos or whatever else they do. And the fake piles of cash they walk around with. If it's real piles of cash, maybe it is real piles of cash. Well, if it's real piles of cash, they deserve to get bumped in the head. But that's another conversation altogether. So what are the lessons here? Well, on this particular trade, you don't want to watch your equity unnecessarily. That's one of the problems with all these brokerage accounts, or I guess it's been like this forever, but with the brokerage accounts, especially nowadays, you get to see each little penny go up and down, each little dollar go up and down, and you can really get caught up in, borrowing a term from David Keller, who I forget where he got it from, but flickery ticks, watching all the flickery ticks and getting caught up in it. I can give you a really good example of this lately, although I fell victim to it in this particular trade. Another good example is a client of mine was in a trade that I had recommended, and he accidentally exited the trade. He went to sell something else, and he accidentally sold the trade, but he immediately bought it right back, which I thought was a pretty good thing to do. It takes a lot of discipline instead of trying to, well, let's see if it drops a little bit. If it drops, maybe I just won't even buy it back, or maybe if it goes up a little bit or whatever. And you start all this kind of Jackie Mason kind of mentality thing going on in your head. But rather than do all that, he just immediately corrected his mistake and bought the stock back, which I thought was a really smart thing to do. Unfortunately, and I forget the exact numbers, but let's say he had 10 points profit in the trade and he had 100 shares left over, kind of like the Beaky trade, right? So he was showing a 10-point profit. He accidentally sold the trade, bought it right back, and then the trade retraced a couple of points. So now every time he looks at his account, he sees a $200 loss, which is really, if you add it all up, an $800 gain going back to the original position. Anyway, long story endless. I know, too late. Long story endless, he decided, I don't like looking at this negative number in my portfolio, even though it's irrelevant. It has nothing to do with anything. And I get it. And I've had trades do the same thing where I'm still actually in the trade after a mistake or whatever the case may be, and I'm seeing that negative number, and the rest of my portfolio is looking pretty good. It's hard not to have that weigh on you. And in this particular case, I tripped over the nickels while going for the dollars. Another dollar slide in this particular case would not have killed me. I think it was $1.20 slide. So let's say I lose $120 per 100 shares. So what? I can kind of sweep that under the rug. You don't want to do that every day and all day, but if that's what your stop calls for, then by all means honor your stop. I already let it retrace 8 points on me, or 9 points on me from the high. So that was like a $900 loss, open loss that is, to open profits. What's another $120? And had I been able to just ride it down to that stop and follow my plan, maybe I'm beating myself up too much here. Well, I think it's important for me to get angry, and I think that if you're making mistakes and you get angry, that's okay. I think that's all part of the psychological game, which we're going to get into in a few minutes. But you want to be careful not to trip over the nickels while going for the dollars. And I was sitting there worried about that $120 gain evaporating after watching a $1,000 plus gain evaporate. And like an idiot, I got out of the trade. So don't trip over the nickels while going for the dollars. That's an old Wall Street adage. Now, the other thing is be willing to take the heat when that's what the plan calls for, okay? So my trading plan called for me to take 10 points of heat. I know it's painful, but the share size is adjusted down accordingly to the volatility, and we're only looking at 200 shares on a 100K account. So you have to be willing to take that heat if that's what the plan calls for. So again, not to beat a dead horse, but an extra $1.20 would not have killed me, especially after giving up all those open profits to begin with. So follow the plan. Now, another thing, if I have to go back in and see why I did what I did, is I think I was a little caught up in current conditions. I was getting stopped out of a lot of my positions, and I was being a good little trend follower and following my trading plan. So my trading psychology was on point, and I was doing the right thing. But in this particular case, in perfect hindsight, I'm like, you know what? I'm getting stopped out all the rest of these. This one's probably going to stop out anyway. Why give up that extra $1.20? So the other lesson is do as the Grand Poobah says, not as he does. Every now and then I feel like the old plumber having the worst pipes. Now let's hop into an example which kind of dovetails nicely into what we just talked about. So this is a former mystery chart follow-up. This is LAC. And I'm using the ACP plugin, which is free to StockCharts subscribers. I can't help you with your subscription. That's up to you. And quite frankly, I think it's important to have a little skin in the game, and that's why I think as far as my educational business is concerned, it's like I like to see people have a little skin in the game. Become a member of DaveLandry.com. It's relatively cheap, and then that way you have some skin in the game, and you're more likely to follow along with these things as opposed to just looking at things more casually. But before I digress too far, oh, by the way, the plugin's free, but you have to like this video. So if you're watching this on YouTube, make sure you like this video. Also, leave a comment down below. Let me know what you think about it. I read and answer all my YouTube comments. So you can see it pulls down or pulls back to the 30-day exponential moving average. Right now, that's my favorite moving average. It seems to be working out really nicely. You can see back here, we had a nice little uptrend. This is the Landry light. This counts the number of lows greater than the moving average. And a simple little setup, and this is something that I wrote about in my second or third book, I forget which one. And I called it Kiss Ma Goodbye, and now I'll call it Landry Light Pullbacks. And in the book, I used the 20 EMA, which you could use, but I prefer, at this point in time, the 30, because a lot of these go-go stocks really take off, and I think it's important for them to have a little bit deeper correction, as I've been talking about quite a bit. So anyway, the Landry Light goes from a very high number, and right now I have these parameters set to 30 EMA again and 10 for the reference lines. And I think 10's a pretty good little trend. If you can get 10 bars above the 30 EMA, lows above the 30 EMA, 10 bars of daylight, and then look for a pullback, that daylight to go from, or Landry light I should say, from wherever it is down to zero, in other words, an intersect the moving average, and then look to get long as a stock begins to rally out. So I decided that my parameters were to enter here, a stop was down here. I think about a couple of points is what we were looking for. Additional profit target here. Initially, it didn't do a whole lot, but eventually it began to take off, nails the initial profit target, and then I began to trail that stop higher. Now, in some cases, you might trail the stop higher, just FYI, before that initial profit target is hit. But once it's hit intraday, you want to make sure that stop is up to break even. And let's take a look at what happened afterwards. The stock sells off a little bit, and then bam, trades through the stop. Notice it turns right back around and goes straight up, just like that Beaky trade, right? Well, in this particular case, this was not a mistake. I actually followed the plan. A client emailed me, or actually texted me yesterday, and said, "Hey, Dave, man, that LAC is looking great. Do you still have that in your portfolio?" I'm like, "No, I got stopped out because I followed the plan." So this guy is 5 points or 4 points higher. Percentage-wise, it's huge based on the number of shares we put on in this particular case. But the market has rewarded bad behavior. And that's a reoccurring theme I've beat the dead horse on so many times about the market is a bad teacher because it often encourages bad behavior. And I think he had one or two other stocks that he was still long. And some of these stocks I think stopped out a long time ago. Now, nothing wrong with giving it a little bit of discretion. In this case, I think I stopped out about 780 as opposed to about 8 where our stop was. But I had to get out of the way. And yeah, I still get a little upset when I see something take off without me. But in this particular case, I have to feel good about myself because I actually followed the plan. Now, let's take a look at this week's mystery chart. In this particular case, since it already triggered around 13, I'm going to call it no mystery chart. So if you are seeing this, it's still likely a viable setup, provided it hasn't traded too much above this high in here. And once again, same sort of pattern, reoccurring pattern you can see if you are watching these shows lately based on the ACP plugin. We've got nice Landry light below. Here were the parameters: buy at 13 and stop at 11.25, which gives us an initial profit target of 14.75. The risk is 175, so based on that number, you would buy 1,143 shares per 100K. Obviously, round that up or down, depending on if you want to be a little bit more or less aggressive. So down here again, you can see nice uptrend based on the Landry light. Little pullback to the 30-day exponential moving average. And then it triggered an entry around 13. Our stop is down here, and the initial profit target is up here. As I said in last week's Dave Landry's The Week in Charts, which again you can watch at that aforementioned YouTube link. Once you figure out your entry and your stop, then your initial profit target is an automatic calculation, as is the number of shares based on your account size. I have all this in a spreadsheet, and that spreadsheet is available to members of DaveLandry.com. It's also available in that StockCharts link that I mentioned earlier. So you can plug in your own trades and follow the methodology similar to mine with the spreadsheet. So if you want to see most, and the reason I say most is a few of these trades that I mentioned as mystery charts do come from the Facebook group. My goal is to never show you anything that, one, I haven't mentioned before, either through my trading service or in the Facebook group, and two, never show you anything that I myself will not take, okay? So if I show you something, I've either already taken the trade or I intend upon taking it. For instance, the one we just looked at, DMYC, I did not take the trade yesterday based on a little bit of discretion. That's not breaking the plan. That's a little bit different, and it's a little bit more advanced than I want to get into today. So I don't feel bad about not following the plan exactly in that case, because part of my plan is to exercise a tiny bit of discretion, just like I said earlier, being able to give a stock a little bit extra wiggle room around the stock in attempt to stay with the position. So anyway, if you want to see these warts and all, as I often say, DaveLandry.com/archives, go in and check out my recommendations. Now, what is my awesome ACP plugin saying about the market? By the way, I do not get paid when you buy a plugin because it's free. And the point I'm trying to make here is don't worry about this particular signal or potential signals, whatever, but more importantly, understand the concept that I'm trying to show. You know, what's the old saying? Give a man a fish, he eats for a day. Teach a man how to fish, he'll sit in a boat and drink beer all day. All kidding aside, just in case I get hit by a beer truck, if you understand the concepts, whether we get a signal tomorrow, next week, or next year, you'll understand where I'm coming from with all this and be able to apply it to your own trading. So this is proper order of the bow tie moving averages, which is a 10-day simple, a 20-day exponential, and 30-day exponential. It's counting the days that the market is in proper order, and that just means the 10-day simple is above the 20-day exponential, and the 20-day exponential is above the 30-day exponential. And you can see way back in July, these crossed back over to the upside, and we've been in a pretty decent uptrend ever since. So you can see nice little uptrend, and then the market begins to sell off a little bit. Now, you don't want to sit around and wait for a crossing to occur, but you can say, okay, so far this is just pulling back, but I do need to pay attention. I do need to honor my stops. I'm not going to sit around and wait for everything to cross over before I get out, but if I get stopped out, I get stopped out. But you can see the moving averages, even though they were still in the green, so to speak, based on the proper order down below, they had begun to turn down, and price itself had begun to sell off a little bit. By the way, as I preach, I see indicators not as indicators, not indicating anything, but more as illustrating what's already in the chart. And as these indicators begin to turn down, it's like, well, lo and behold, the market has begun to roll over a little bit. So there will be some lag, okay? And again, honor your stops just in case. Now, notice when they begin to cross over, when that 10 dips below the 20, this little illustrator down below, or indicator if you want to call it that, turns yellow. And once all three moving averages are in downtrend proper order, the 10's below the 20, the 20's below the 30, then it turns red, okay? Now, you can see we did cross back above those moving averages, and if we stay above 33.50, round numbers, those moving averages will turn back up to the upside and eventually go back to uptrend proper order. Now, Landry Light has been one of my favorite indicators lately, as you can tell from watching these shows. Notice that way back in July, the lows were greater than the 30-day exponential moving average, and they stayed that way for a long time. And then you can see they began to turn, or the indicator began to turn when the price crosses below the moving average. Now, all you need is a low to touch the moving average, and then this gets reset to zero. By the way, as I've said quite a bit, this does not measure magnitude, okay? This is not like an MACD or something that measures the distance away. This simply measures the number of days. So we had 41 days where this moving average was untouched. So that means you're in a pretty darn strong uptrend. And you can see that that goes back to zero once the moving average is touched. And we had 1 day of Landry Light below, and then no Landry Light, 1 day above, and then we went back to no Landry Light. So when you start seeing reds and greens interchanging down here, that could be a caution signal. And then you can see we started getting some downside Landry Light, meaning the highs are less than a 30-day EMA, so that's not a good thing. But then you can see we crossed back above it, and the indicator down here goes back to zero. So we are at a little bit of an inflection point. Also, pay attention to price itself. So if we get above this high here, that would suggest that the market is okay. If we take out this recent low, that would suggest the market would be in trouble. Staying above this recent high, let's just say 3,400 or more, or 3,450 at least or more, and then obviously getting above this high would be a good thing. That would cause these moving averages to turn right back up. If you watch the market in a minute on my website and some of the other posts and presentations that I've done, you'll notice I have a silly little banner ad where I say, hey, if I could wave a magic wand and solve one of your trading problems, what would that be? And that's stolen from the motivational people. They tell you that, okay, if we could wave a magic wand, if you could wave a magic wand, what business problem would you solve? And you'll just say, well, I would solve this. In a lot of cases, that problem can be solved with a little bit of money or a little bit of work, and it's not really a problem. So borrowing that line of reasoning, I thought it'd be fun to put out a banner ad where I ask for problems. And I've got quite a few of them. And to my surprise, most of them, or I'd say 99% of them, are fairly easily solved. Now, let's take a step back real quick. And as I talked about in the first show, the reason technical analysis works is because the market participants often behave in an irrational manner. The market is emotional. Yogi Berra once said, if the world were perfect, it wouldn't be. And I could not agree more. Now, as I've said before, trading with technical analysis is reading the emotions of the market's participants while at the same time embracing your own. Now, there's a whole neurology that gets into the fact that you cannot make any decision without emotions. And without getting into a long, drawn-out presentation on that, just know that it's a fact. You cannot make any decisions without emotions. So just keep in mind that markets really exist all in your head. And a lot of research I've been doing lately confirms that. This reasoning comes from people like Mark Douglas, where he talks about what you're seeing is not the actual market, but the perception of the market in your head. And I've done complete presentations just on that. So what I would encourage you to do is become consciously competent. Know what you're doing. I've had some of these Robinhood traders, friends and friends of friends, come to me lately like, hey, I made 60% in my first month. Is that good? It's like, yeah, well, you made $600, $1,000. That's fantastic. You're not going to do that every month. And most of these people have since, I wouldn't say blown up, but have since traded their account down below where they started. So initially, you don't know what you don't know. So you need to actually work to a point where you know what you're doing. Maybe trade something really simple like Landry light pullbacks that we'll be talking about in this presentation and the last probably 6 or 7 presentations prior. The other thing is realize that the money management, your mind or trading psychology, and the methodology are all intertwined. A lot of times people say, Dave, is your money management statistical or psychological? My answer is yes. The shorter term swing trade profit portion of it helps to fill that microwave society initial need that we have for instant reward. And the longer term piece helps that climbing that Maslow's hierarchy of needs, not to go all freshman psychology on you, but helps you to get that self-actualization. Now, statistically, those longer-term trends don't come along very often, about 28% of the time. If you're lucky, it just doesn't happen that often. The swing trade is more likely to happen. But if you can get the swing trade off and get a free position, so to speak, then you're ahead of the game. Now, speaking of money management will cure a multitude of sins. A lot of the problems that I received can simply be solved by putting in a hard stop and honoring that stop. And if it's a hard stop, the market will take you out of the position if you need to be taken out. Well, we're out of time and we're just scratching the surface here. So we're going to pick up on all of this and I'm going to give you some background on some things you could do to help to avoid these problems in the first place. And I'd be willing to bet a lot of these simple things will help you to solve many of your problems. But again, we'll pick up on this again next week. If you need to reach me, again, davelandry.com/contact. If you want information as far as the slides, my 3 books, and a lot of other stuff to keep you busy for a long time, including limited access to members area, davelandry.com/StockCharts. Everyone, thanks for watching, and may the trend be with you.
Hey, Grayson Rose here with StockCharts. Thank you so much for watching. I hope you enjoyed that video. If you did, consider giving it a like down below, maybe leave us a comment, and if you're new to the channel, you can subscribe at the link up above. We're gonna bring you daily content from an incredible collection of technical analysts and financial experts.